the way that a closed-end fund works is that a mutual fund company says, okay, we're going to make this new fund, the XYZ fund, and it's going to have $10 million in it. And so they get investors to put $10 million into the fund. And as time goes by, those investors who were invested from the beginning can sell their shares. But instead of selling them back to the mutual fund company at the actual net asset value, the underlying value, they go and these shares are listed on a stock exchange. The price that you pay for those shares could be more or less than what the actual underlying value of the securities, the stocks, bonds, et cetera, inside the fund are. And sometimes these funds sell at a premium to their asset value, sometimes at a discount. And so there are people that go, okay, I'm going to put my money in, I'm going to buy shares of this fund because I'm only paying 90 cents for $1 worth of assets. And that seems like a really good deal. And it is, except for the fact that just because a fund is selling at a 10% discount doesn't mean it couldn't sell for a 20% discount or a 30% discount. There is no way, if you own a closed-end fund, even if you buy it at a discount, there is no way, no mechanism to make the mutual fund company liquidate all the things they own and distribute the money so that you actually realize a profit on the discount. Because what's going to happen is someday when you want to sell the shares, you're going to have to go out into the stock exchange and sell the shares, and they could be selling at a premium or they could be selling at a discount. So it does offer some protection in that you're buying things very cheaply, but because there is no way to actually realize that discount, it's really not that great a strategy.